Okay, what a week we've had. So we've got a long video tonight. We have a lot to talk about. So if you need to hit that gear in the bottom, what would be right corner of the video, speed it up so you can watch it 1.5 times speed, 2 times, whatever you need to get through. Because there's a lot of technical patterns we're going to look at. We're going to take a look to see, has the market formed a bottom? Is this as low as we're going to go? If not, how much farther can we go? If it is, why? What technical patterns do we see? Has there been a precedent for this kind of move before? And what happened then? So that's what I'm going to break down today. There's really good volatility in the market. There's opportunity there, and we're going to take advantage. So let's go ahead and get started. Today is Friday, February the 9th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thank you very much for watching tonight. Welcome to those that have found us that are watching for the first time. Glad to have you. Keep coming back for more day after day. Subscribe to my YouTube channel by clicking the red subscribe button right below the video. You can do that right now while you're watching. Also, while you're down there, click that thumbs up icon. That lets me know, number one, that you liked the video today, that you got something out of it, and there's a lot to get out of today's video. Also, it lets me know, number two, that you want me to do it again on Monday. It's a one-click way to give me feedback and let me know what you're thinking. Comment on anything that stands out to you from today's video further down below. Join my daily email list where I send out emails every day with time-stamped hyperlink summaries of what we go over in these videos. You'll see a link down in the description below. Follow me on Twitter for more content in addition to these videos. Like and retweet tonight's Market Outlook tweet, always pinned to the top of my timeline. And then join the Market Outlook community on Facebook. You'll see that the address on the screen. There's also a link down in the description below that you can click that will take you there so you can join. All right, well, let's take a look at the S&P 500 first then and see what's going on. We actually had a cluster here earlier today, but you can see the long bounce, a long lower shadow. That's a very positive sign. You can't really get that much more negative. We could have closed at the low point today, and that would have been pretty negative, and you would have had the cluster at that point. But you notice here, look at the near term. So the intermediate line is strongly bearish. So we went from strongly bullish to strongly bearish. Now I did want to say that someone brought that up on Twitter. Very good point here. That I've always mentioned that we don't go from strongly bullish to strongly bearish. Typically we go from strongly bullish to weakly bearish, and then that bearish momentum builds on itself. Of course, that didn't happen this time. And I will continue to say going forward, we don't go from strongly bullish to strongly bearish, because this is not a precedent-setting type of move. This is an anomalous move. And you can see here from this tweet from Ryan Dietrich that this is the first time in history the S&P 500 went from a new all-time high to a 10% correction in 9 days or less, while also staying above the 200-day moving average, yield curve moving higher, and credit spreads not widening, narrowing. And that was something else I mentioned before with this tweet right here, the credit spreads narrowing with high yield outperforming TLT. So all that being said, going forward, I will still continue to say we don't go from strongly bullish to strongly bearish. We do go from strongly bearish to strongly bullish, though, and that's where we are right now. We are strong bullish posture, and it doesn't necessarily have to happen overnight. There's going to be a lot of volatility here. There's been a lot of reaction about how crazy the market is. When VIX is at 30s and the 40s, like it was briefly earlier, and then the high 20s, you're going to get big moves. We're just not used to it because we haven't seen volatility that high for so long. Intermediate lines below 20. Look at the near-term line, though. You see how we have the potential here for higher lows developing. If you notice over here, we obviously have much lower lows, with the high point being around this 2,700 area right there. So that's our next target to the upside. And again, I don't expect, I mentioned before on Wednesday, that when you get a long lower shadow like this, and we've seen this before too, back over here, and we got a long lower shadow when we were flirting with the 200-day moving average. You'll see that here in just a second. The near-term line was down to its lowest level that it's been since like the 90s. I mean, it's been so long since the near-term line got that low. But you notice the near-term line is oversold. We had an intermediate confirmation signal last week. The momentum line bounced up because of this long lower shadow. But that's a positive development because you notice the near-term line is not extremely low. It's a positive development to have the long lower shadow and the oversold near-term line that fast, coming down from 99. We were at 99 just a couple of weeks ago because we were that bullish during that four-week run. And again, all of this move, you can see we're right around that. We're closing this week the 50% Fibonacci retracement of an intermediate run that you've heard me on this video say that we were long in the tooth, right? It's a very mature run, and it kept getting more and more mature. The tightrope that we're walking kept getting higher and higher and higher the more it pushed up and up and up. Because remember, a typical intermediate run lasts, for those who watch this, who's been watching this for months or years potentially, know that the intermediate line, when it crosses above 50, you can expect a 1 to 3 month intermediate rally. That's a typical time frame, depending upon where market sentiment is. And considering market sentiment was so high, we were actually here looking for more of just about a 1 month run. But it kept going up, and it stayed bullish, and the intermediate line got up. And we even talked about, too, when the market sentiment gets above 80, right there in late October, we talked about we don't typically get very bullish runs, especially considering that we were almost 2 months into this intermediate rally, that we were only expecting to be on the shorter end of that 1 to 3 month range because of how high market sentiment already was. We ended up with a 5-month intermediate run. 5 months, which is longer than longer than we would have expected with market sentiment well below 50. So a strong run. A lot of those gains coming after market sentiment crossed above 80. And so yeah, we had a big bearish drop. And a lot of people are complaining about this. No one really complained about that, because that was especially from about right here, which is really when the tax reform news hit the wires of the expectations for tax reform. From that point right there, where we had a weak bearish posture, but not enough of one to even bring the near-term line below, in the lower reversal zone. From that point right there, we had this strong trending move. We ended up with what? By the time it was all said and done, a 12% rally over the course of 72 days. That's a 78% annualized return. 78%. And so look, we retraced that. We retraced that move from that point forward. That's, here, when we talked about the market sentiment line crossing above 80, so on that day, you can see we closed at 25.69 and 10.24. 10.24, which is right here, right there. On that day right there, we closed at 25.69. We finished yesterday at, well, let's see, I have to get the line here. We finished yesterday at 25.81. And so we pretty much wiped out a lot of the gains over from the time that market sentiment got above 80 that we were not expecting at that time. So we've had a good trending move. It really accelerated, went parabolic to the upside, and it came crashing down. A lot of it having to do with volatility blowing up and blowing up volatility funds and things kind of going crazy there. But I've also kind of wanted to make one more point before we move on to other segments. So, and I've noticed Brandon's been tweeting out a lot of about being stopped out on these trending moves. A lot of people probably being stopped out, which is, and we talked a lot of this here, and I know he did too, about staying small when we're that far up above these moving averages. How bullish we were to keep any new position small, and to take risk off on these existing positions, reduce positions, take profits off the table, reduce positions, because of how big the risk was getting, of how far up, with how far up above the moving averages, how long in the tooth these intermediate trends run. We kind of got complacent because they just kept going, and when it gets to the point where you're like, man, the markets is never going to go down, that's when we worry the most. That's when the risk is the biggest, and we have to take off positions. Now, what's probably happening to a lot of you is, hopefully, on some of your trending trades, you've been getting stopped out, or at least, especially in some of your newer trades, most likely, getting stopped out with losses. Well, hopefully with small losses if you kept your trade small and followed your selling rules. If you don't follow your selling rules and now you're just hoping to get back to break even, you're kind of stuck because it might be a while before we get back up into this area. But if you followed your sell rules and got out, yes, you took losses. But guess what? You have a benefit that not a lot of people have right now. A lot of people right now are stuck waiting for it to come back. They're stuck in their positions that maybe they had sell rules on and they didn't follow. Maybe not. Maybe they're just in them. But they're stuck in their positions and they're having to wait it out in those losing positions, which means they don't have the capital to take advantage of this move. If you've been stopped out of your trades, you have a valuable asset, and that is cash. When volatility gets this high, there is opportunity here. And if you don't have cash, no opportunity. If you have cash, whether it's because you're sitting on the sidelines or most likely because you got stopped out of your trades, great. Yes, you realized some losses that might have hurt a little bit, but how I always said, the VIX tells you your return expectations. When the VIX is historically low, then your return expectations going forward should also be historically low. But now the VIX is not historically low. The VIX is really high, which means going forward from here, your return expectations should be pretty darn high too. And how great it would be to have the capital to take advantage of new positions when your return expectations are really high. Right? You can't do that if you're sitting in losing trades waiting for them to come back up. Because now there's no return expectations. Your expectations are just to recover losses. There's no return in that. It's just recovering losses. And can you recover those losses faster by staying in those positions or by finding other positions newer within this opportunity and taking advantage of those and being able to recover your realized losses quicker that way and potentially then some from there rather than just holding on and waiting for some of your losers that might have lost a lot more because they might have been the biggest momentum players during this run, waiting for them to eventually finally come back. You think about the last, this is definitely not a bear market. Right? Even if it would have got down to 20%, it would not have been a bear. A bear market is when we trend lower for quite some time. A big spike move to the downside is a correction, whether it's 10%, 15, 20, whatever. Right? That when you get a big spiky move like this to the downside, especially from all-time highs. Now you can get this kind of a move after when you are in a bear market, when you've been trending lower for a while. We're not trending lower right now. We're still, this is 38% Fibonacci retracement of the long-term trend. So, we're just pulling back on the long-term trend. We're just doing it very quickly. We went parabolic to the upside. We retraced that parabolic move now to the downside. That being said, that long lower shadow offers opportunity. That bullish divergence, near-term divergence, offers opportunity. Market sentiment's down. It's weakly bearish. Intermediate posture is strongly bearish, but short-term sentiment is starting to improve, and there's opportunity there. If you take a look at the other indexes, you'll see very similar patterns. Similar right there, long lower shadow on the Russell, on the Dow Jones Industrial Average. Because remember, correlations get close to 100% when everything's falling. Look at that long lower shadow on the Nasdaq, and still same near-term divergence setting up there as well. And then finally, the Russell 2000. Long lower shadows a couple days in a row. You notice that long lower shadow from, Tuesday? Held for support yesterday. And we went down below it today, but closed. So that long lower shadow is still holding for support on the Russell 2000. Now you have a new one. This one down here that we can also trade in. But again, bullish divergence on the blue line, on the near-term line. Intermediate posture oversold, setting up for the possibility of a bounce back up. Now, again, I don't think we're bouncing back up to new highs anytime soon, but definitely opportunity to bounce back up into this area here and the equivalent areas and all the other major indexes. All right, when you look at the long-term chart, so here's what I was talking about before. Look how high the MACD still is. So there's still quite the gap between the 50 and 200-day moving averages. It's not going to be a week or two before those close, unless it just obviously collapses. But I mentioned before, we've seen a test of the 200-day moving average with a long lower shadow before when you've been on a strong bullish trend there towards October of 2014. a lot of chatter about this being very similar to 2015, and that's what the candle looked like there. We were well below the 200-day moving average. So we finished the week up above the 200-day moving average. As volatile as the past 2 weeks have been, that's what it looks like. So long lower shadow, you've seen in the past, long lower shadows set the bottom. All along the way, they set the bottom here. So we'll see if that ends up being the case. Now, it doesn't have to immediately go up. Some weeks it will immediately go up off of that bottom. You can see some, when it's below the 50, it will jump right back up. Here it's below the 200 1 week and jumped right back up next 2 weeks. Boom, boom, just like that, up to new highs on October 14. In 2015, though, the week that this is compared a lot to, we were down for another 1, 2, 3, 4, 5 weeks. Got another long lower shadow before we rallied. Boom. And with a 5-week run up close to all-time highs, back again above the 200-day moving average. So that there's a chance that we could bounce and rally right off of this, as we've seen in the past. Or there's also opportunity that we continue to trade within the range and use the low point as a support level. Either way, the long lower shadow is bullish. It's just a matter of timing, and of course, timing is the exact timing is impossible in the stock market, but expectations is what we base everything off of. And we expect that long lower shadow that will bounce. Probably not going to bounce up to new all-time highs, but probably, again, we've seen in the past where we've had a strong January, despite the pullbacks throughout the year, you still finish the year stronger. So, if you're looking for, if we were to go out here to end of 2018, and we're going to bring this down here just like this so we can kind of get an idea of expectations, right? I'm going to zoom in. I'm going to zoom in on right there, the end of 2018. So you remember the average return for the full year over 2000 and the average when the January is up 5%, the average return is like 24%. So if we're going to get a 24% return by the end of 2019, you can see I'm looking at this number right here. In fact, I have to kind of zoom out a little bit. So right there, that's what we're shooting for, right there. That kind of a return by the end of 2018 would get you. And you notice, if I were to draw a line up through, what all of these low points here, all these high points, that's about the kind of move we've had. A little bit of a tighter angle than what this trend has been. But you can see that's the kind of move that we've been on. And of course, to get back up to that kind of move, we were obviously well above pace for that. That first down week, we got down to the pace. And now we're back below the pace. But you can see now, to get from here up to that level, you look at the rate of changeover. That's a 27% return over the rest of the year, the 336 days that we have left in the year. Again, considering the VIX is as high as it is, that kind of return is not out of the ordinary. So again, you don't want to just say, okay, well, now this bullish trend is out of it, because as we've seen before, when we've tested 200-day moving average here, we can still continue to move higher. And that was, the only reason why we had that kind of a drop where we tested the 200s, we ran out of QE. We still have all the fiscal stimulus. It really hasn't even kicked in yet, because we're just barely starting the new tax year where they can take advantage of the tax advantages. So, and we haven't got the what's it called? The infrastructure bill. We haven't got the infrastructure bill yet. Which is a possibility this calendar year. And of course, we just got the budget passing. So we'll see, it's not like we just ran out of fiscal stimulus like we ran out of monetary stimulus over there. And remember, they're not restraining monetary accommodation. They're not being restrictive right now. They're being less accommodative, right? They've been so accommodative that the balance sheet is so high. I mean, yeah, they're raising interest rates, but the interest rates were far below zero. So they're kind of returning those rates back to a normal level. Once they get above the normal level, that's when they start being more restrictive. The balance sheet is still way up above its normal level. So they're just pulling it back, and they're pulling it back at a really slow pace. So it's not like they're being restrictive. They're just being less accommodative. So there's still a lot of monetary stimulus out there. So from a fundamental standpoint, despite the 2-week decline, there's still that possibility of the market returning what has returned before on average every single year that the January has ended up 5% or higher. So if you take a look now at the 3 green arrow chart, you can see obviously we have we have 3 red arrows. The MACD, and that was something I pointed out as well on Twitter right here. So the MACD is now as negative as it was positive. And remember, that was the highest positive figure we've ever had. This, however, is not the biggest negative figure we've ever had for the MACD between the 8-day and the 17-day moving average. You can see in 2016, 2015, almost in 2014, 2011, and of course back here in 2008 at the worst of the financial crisis, when we were already in a bear market by the time we had that kind of decline. So if you go back to these other times, you can see I put the numbers here. 70 days later, so roughly about 3 months, less than 3 months later, the market was up 13% in 2000 off of that low point right there. When the MACD was as low as it got, we were up 13%, 70 days later. In 2016, off of that low, we were up 13% 96 days later at the peak. At the peak of the MACD, you can see when the MACD peaked, you can see how it got up really fast too. And then going back to 2011, right here, from that bottom to that peak in the MACD, so right to that high, we were up 80 days later, 14.5%. So 3 months from now, are we going to be up double-digit returns off of this low point? According to past precedent, according to recent past precedent, the odds are pretty high. When you look at the intraday chart, you can see how we were at one point in time. In fact, that dropped down to 252 after peaking here, on the 4-week high point up around 287. We're looking at almost a 35-point range for the 4-week average. For the 4-week range, that's a humongous range, and typically, it's hard to continue to go down. So when we're not pulling this down, which we're not going to be pulling this down anytime soon, and you just push down really far, really fast, which usually happens at the end of a kind of a bearish move. In this case, this bearish move wasn't very, we didn't go from strongly bullish to weakly bearish, and then it built up on itself, and then, the capitulation and we jump, right? It was hard selling right off the bat, and we've pushed the range without ever really pulling down the all-time highs. That's still the all-time high for the 4-week high. So you can see now we've bounced back up off that lower high, lower low, but finishing closer to the high than the low point. Relative, as positive as can be for a day like today. You can see the range continues to be very high. The range today at over 10 points after a range yesterday of about 10.5 points. But you can see the long lower shadow there on SPY. You can see the volume. In fact, if you look at the volume for the whole week, 1.3 billion shares on SPY. The last time we had more than that was over here again, August 2015. But that was a high week. You notice we started the week really weak, and then we finished the week very strong. And then we filled in the range before bouncing. But that was actually a bullish week with all that volume. So the last time we had this much volume on a down week was October 2014, another period where we tested that 200-day low point with the long lower shadow. And you can see again, we followed that with 1, 2, 3, 4, 5, 6, 7 weeks in a row of gains up to, at that point in time, new all-time highs after touching the 200-day moving average. So we've got precedent for this much volume, which is more than 3 standard deviations on the 5-year basis. But precedent for that much volume usually leads, especially with a long lower shadow, to a bounce here. And if you take a look at the You know, the range, of course, 10 points is well off the charts. The volume, again, well off the charts here. Very, very high levels. And again, when you look at these levels on a compared to the past, in fact, we have to go back pretty far to get the ATR this high. I mean, the last time the ATR, the average range, was this high for SPY was 2008. It never even got this high in August of 2015 when we hit that low, that strong low point, or in early 2016. And again, remember, when we get to these peaks, you can see how we grind down as the market bounces off these sharp lows, especially when these sharp lows come right off of all-time highs. Not at the end. The last time we were this high, we weren't coming off of all-time highs. We were coming off of the bottom of a bear market where the bottom fell out. The bottom's not falling out here. This is still, look at the bullish trends, actually still intact from a long-term standpoint. And then you take a look, you can see volume. Volume's a little bit different, not as high as it has been, but the trading ranges. And of course, the price is a lot higher, so you have to put that in context This is a lot bigger because we were at 75 on SPY compared to 261 now. So that range was a lot higher on a relative basis than where we're at currently. And then finally, we'll take a look at volatility here. You can see a little bit of a double top forming in volatility at 40 with the low just under 22.5. So there's opportunity here for volatility to start its decline down to new lows. And we talk about how, and I've shared this before. Okay, this is a chart here of if I got you on. Okay, good. Just making sure I got you on here. All right, so here's a chart of the it's a monthly chart of the VIX, but it's not first day of the month, last day of the month. It's options expiration, and you can see there's been times where we've had big spikes in volatility in one expiration cycle. You can see here, even in August 2015, boy, that date sure seems come back again and again. That was the last time we had that big of a move with a long upper shadow. And again, the last time we finished this high was that week before that August 2015. And before that was 2011, July of 2011. Look what volatility did within 1, 2, 3, 4, 5, 6, 7 weeks. It was back down, closing below 15 after getting up to 43. Over here, we got up to 40 in April of 2010, and within 1, 2, 3, 4, 5, 6, 7 weeks, we're back down to 16. So where are we gonna 7? I mean, here the last time we got up to 28, which is about almost where we closed here, was August. It was at July 2015. That next week was August, or next month, excuse me. So it'd be 7 months, sorry, not weeks. But within 3 months, we were back down to 15.5. We spiked back up at the end of 2015. Within 3 months, we're back down to 13.62. So within 3 months, are we going to be back down to 15? Now, I don't think we're getting back down to 10 or 12, but are we going to be back down to 15, 16 within 3 months or 7 months, according to past precedent? And you can see how volatility is still very high. Even though we're double topping on an absolute basis, we're still up above 1, which is the overbought level. And once you get up above 115, that's extremely high. So as extremely low as volatility has been lately, that's an extremely high figure for us to be at closing the week up above 115. So volatility is at an extreme, needless to say. When it gets to extremes, it tends to revert to the mean. We reverted to the mean after being down so extremely low for so long. We've been reverting back up to the top over here in this last few weeks, last couple of weeks. And now, it doesn't stay up here very long. It stays up to extreme highs a lot less than it stays down to extreme lows. And so again, the expectation is volatility will creep downward, as we've seen before, 3 to 7 months, over 3 to 7 month period. All right, now let's transition into what's driving the price action today. And you can see, let's go zooming in on just this week first. Of course, the dollar is the biggest beneficiary of all this flight to safety, as it stayed up 1.5% for the week. Remember, the dollar's been really on a bearish trend. It's just this bounce that we've had is just an oversold bounce. We talked about that earlier in the week. You can see that treasuries have held ground. In fact, the corporate bonds, which is this high yield ETF right here, finished the week about with the same level of gains or losses as the long-term bond did. This is a long-term bond ETF in blue. Both down 1.5% for the week. Usually, and you can see even gold down. Of course, dollars up, gold's down. So your typical flight to safety includes all these asset classes, but considering how strong the dollar was, it put pressure on all these other assets, including crude oil, which is down 9% this week. So you think stocks had it bad? Crude oil had even a bigger decline. Rig count coming out today putting more pressure on crude. But crude pretty much falling in conjunction. So it's like, okay, is crude falling because stocks are falling, or stocks falling because crude's falling so much? Usually that's one of the more volatile asset classes. But you can see too from the low point here that we had this morning up to the close, stocks are up 3% off of this afternoon's low point. And you can see it was all equity asset class, all equity classes that moved up. And in conjunction, you can see crude oil bouncing up, but not nearly to the same extent, about half of the gains that S&P 500 had. And you can see corporate bonds just whooping up on treasuries again. So, you can say, well, a lot of what we've had, is because of this sharp rise in yields has put pressure on stocks. Well, if you notice, the first 4 weeks, we broke through 2.6%. The stock market rallied like crazy, up to crazy highs from a technical perspective. Then we had this week where we rallied up above 2.8%, and now all of a sudden that's when the market cares. And remember, we've had this kind of a move before. Back in 2013, during the height of QE3, the yields went from 1.7% here, 1.66, all the way up to 3%. We haven't had that kind of a move. We've come off of 2.1, just under about 2.05, up to 2.8. So, and we've seen this too. When the election came out, we jumped up from 1.8 or just under 1.8 up to 2.6. So there's a lot of chatter about how yields are getting up to 2.8% and the 10-year yield, and that's putting pressure on stocks. But the reality is there's been other times. 2013 was one of the biggest bullish markets that we've had. Again, during the height of QE3, and we had one of the biggest moves. I mean, look at the MACD for the 50 and 200-day moving averages for the 10-year note, as high as it, higher than it's been in a long time. Whoops, here, let's get back to the weekly chart so you can see it better here. There we go. So you can see, it was pretty darn high in 2013, yet the market was screaming higher during that run because of all that flood of QE quantitative easing that was coming into the markets. Because it was higher back in 99 and the beginning of 2000. At the height of the tech bubble, we were at 6.5%, double we're at. So yeah, the MACD is running. I mean, we're bullish. We've had a decent run, but we've had other runs that have not put this much pressure on stocks. What's happening is what we see in all these other asset classes is this is a stock market correction. It was purely a stock market strong run higher that got away from that long-term average. Remember how we were looking at linear regression trend lines? We're outside the second standard deviation day after day after day after day, week after week, even on the 10-year, 5-year, every time frame we were looking at. We're pulling back. We're pulling back now, and we're not seeing this broad. We're not seeing this broad sell-off in asset classes. Like I said, corporate bonds are holding their values actually pretty darn well, considering. In fact, if you take a look, so during this run that the stock market's been on, it's getting up to 50%. Corporate bonds have had a 25% rally during that time. And, you can see they turned a little bit faster. They peaked earlier than stocks did. And you see stocks made this run right here. So really off of this peak here, you can see stocks kind of went away from up 7% while corporate bonds were just kind of flat. So that was, again, another kind of a sign that stocks had dislocated. And so now stocks have pulled back to where, back to their kind of long-term trend. If we take a look at that linear regression trend line, look how quickly things change. And we were at one point in time, after being above the second standard deviation channel, we were below the lower second standard deviation of the band of that channel. So that quickly we went from one extreme to the other. Take a look at some of these other time frames, and you can see again we were above the 2 standard deviations on a weekly chart even. And you can see at the low of the day we were right back to the long-term best fit trend line. Now take a look at even a longer time frame than that, the 10-year chart here. We were outside the first standard deviation channel, and we're still well up above the long-term trend line, best fit trend line that we've had over the last 10 years. And going even back even further now, you can see 20 years we were above the second standard deviation trend line. We're still above the first standard deviation trend line. So we're still very, very bullish. And this 20 years, of course, includes 2 bear markets. But we're still very bullish. We've had to look at that run since the beginning of 2016. The last time we had a significant move below the 200-day moving average. Look at that trend we've had since then. Really about from this low point right here, all the way up to the very tippity top, 54% gain, a 24% annualized return over a matter of roughly almost 2 years. So you've had a good run. A lot of your trend trades, in fact, a lot of Brandon's trend trades from his trend trading class that will be rebooting here, are just now barely getting stopped out. They've had that good of a run over such a long period of time. And like I said, not a bad thing considering now it frees up capital to now employ, with stocks now back at much better levels to adjust return expectations for than getting into new trades when you're outside 2 standard deviations of a 20-year time frame. The longer the time frame, the more significant the technical signal is. In this case, reversing itself really, really darn quickly. But the idea is, much, much better opportunities here than there have been just a couple of weeks ago because of how high that tightrope has been. Now we'll take a look at the sector rotation for the week, and you can see, not surprising, energy stocks were the biggest loser with energy being down. Everything else all lagging behind. Utilities, when we were at our worst point here with the S&P down 8% for the week, utilities were only down half of that. So about 4.5%, finishing the week after lagging significantly, finishing the week only down 2.5%. So you look at the 4-week range for a lot of these asset classes, because it's been a couple week decline, right, for the stocks. And again, down 11%, more than 11% at one point, now only down less than 9%. But at that point in time, you can see how utilities, real estate, which have been the biggest losers for so long, bouncing up and having the least amount of loss. Consumer staples in there as well. But you can see how when we are in stark sell-off mode, it's not the correlations come right back closer to 100%. Everything goes down. Some things go down less than others, but everything's going down. You can look at all these technology, consumer discretionary, financials are down there, industrials, healthcare, and especially energy down 16% at the lowest point since the stock market started this sharp decline. If you're looking for the types of stocks that can lead on the way higher, you can see again during this rally, this afternoon, from off the lows rally, technology, energy, consumer discretionary, industrials, and really by the time it was all over, technology was the biggest outlier. And all these safe haven sectors rallied too, not to the same extent. Utilities and staples up 2%, not the same as what the broad market, but technology leading. And one of the stocks that has actually had a pretty decent week with earnings helping was Nvidia. You can see it got, it's the last couple of weeks have been a down week for them, just like everything else. You can see you got the piercing line here where you gap down below the low point of this long lower shadow and then rallied back up through the midpoint of that candle. You can see which area held, which is right about these old high points in that level. It held for support on the way back down before earnings, and then you can see now with the earnings announcement, we rallied off of that, gapped up, went up to a new, or gapped up way up above these highs, came down, hit that support on an intraday basis before finishing with everything else off of those highs. In this case, finishing off above its 8 and 17-day moving averages, and even the 8-day moving average coming really close to crossing back up above the 17, which is what the MACD looks at there, and the stochastics setting up for a potential phantom green arrow setting up on that as well. So, and would be a higher low point. If you look at the 3 green arrows, you can see obviously you got 1 green arrow on the moving average. You still got a while to go before the the MACD crosses above its moving average, which is what gets the green arrow here. And you've already got the potential, the phantom green developing on the stochastic. So you're 2 out of 3 with some strong volume and holding support. So you can say, okay, well, you've got support down here, the long lower shadow right around 220-ish. So if we were to say sell that 220 put, again, because things are so crazy, volatility is higher than normal, things are so crazy with the markets, we don't want to be too aggressively bullish, but we can start building in some positions. You can sell puts. Selling puts allows you to build into a position on a stock that you like that's really cheap, but you don't want to buy right now. Because again, for an example, I could buy Nvidia. I could sell a put on Nvidia if I wanted to buy it. Say sell this 220 put, buy itself, and make $8.70. Which means, if this stock were to go down $8, I'm still okay because of what I've sold in this put, and I've got 220 is actually $12 away, minus the $8, almost $9 I would get from selling the put down to 211. So I have a pretty decent wiggle room for this stock to trade in with the ability to buy the stock at 220 if I wanted it. And if it starts to bounce back up or just kind of messes around in this long lower shadows range, as you can see on the weekly chart here, this stock is in a pretty decent, it's got that long lower shadow, so it can muck around in this area in the range of that long lower shadow. But you can also see I'm not too convinced of the long-term bullishness just because of that divergence setting up on the MACD and the 50 and 200-day moving averages. Doesn't mean we have to tank. It just means whether or not we're going to have a year like 2017 again, where we didn't really have that divergence developing heading into that year. So that's a little bit of a concern, the longer term prospects. So we say, okay, well, instead of selling that put so I can buy the stock, it's like I can buy the stock when I get 3 green arrows with my buy signals. I can sell the put until then, like I said, get an $8.70 jump start on any kind of return I would look to try to get on it. Or I can say, let's just sell the 870 put. It would take a lot of capital. It would take $3,400 of in this margin account as an example, or for a cash secured put, it would take $21,000 of capital. So you can say, okay, well, I can do that, or I can buy the 215, probably end up getting right around $1.44. Now I only need $356, and now I'm only getting $135. I get a pretty decent return on my risk there. And if you notice, there's a pretty decent probability of it staying above 220. That's what, in this case, above 218. And you see where that break even is on the chart. It's down here, right where that support's going to be. The bottom of today's candle, the midpoint of that range, that old high. So all that support is going to be down in that area. If we break that support, you can see where this crossover is, I'll lose about $100 where I'm trying to make about $144. So I can take whatever small loss that one, free up that capital, and go look for something else. If it doesn't, if the support holds, then I make a pretty decent return on my risk for a trade. That's got a potential, and if it starts to bounce back up and continues higher, great. I can be able to buy the stock whenever I finally do get the buy signals on it, or I can just sell this put, take advantage of the high volatility we currently have, higher than normal, and just start looking to take advantage of all this volatility as it potentially and eventually creeps back down over the next so many months. So with that being said, it's been quite the week. Hopefully it's been a very good learning experience for a lot of us out there. As you watch these videos day in and day out, there's a lot of opportunity right now. And if you're stuck in positions waiting for them to come back because of this deep pullback, then unfortunately we can't take advantage of these opportunities, which is another reason why we use stops, which is why getting stopped out after long trends and locking in those profits and freeing up capital is actually a good thing, because it gives you the ability to take advantage. If you're stuck with unrealized losses because you didn't use stops or you didn't follow your sell rules, then we're stuck. So we'll take it. We'll talk about as this volatility starts to wind itself back down eventually. And we'll talk about how it's going to do that, what's going to drive, what's going to lead, what's going to lag, and how you can be able to take advantage. So stay tuned as always, day after day. Again, thank you very much for watching. Have a great weekend, everybody. We'll see you all on Monday.